Hello again, everybody. We are looking at adjusting entries this week in Principles of Accounting, and I wanted to take a moment to kind of give you an overview of one of the most common adjusting entries that you're going to make, and that's depreciating an asset. So we're going to take a little example here. I'm going to say hypothetically that I decided to go into business for myself, and what I'm going to do is I'm going to buy a pop bike. And basically, the idea is I'm going to buy this bicycle, fill it full of popsicles, and I'm going to pedal from Southern State campus to campus and sell popsicles to people. So it'll work out pretty good, I think, in the warm months. You know, we don't have any cafeteria options at the college. It's just going to be me and my bicycle bringing refreshing treats to you as you take a break from classes. So really, all I need to get my business up and going is the bicycle itself. Okay? So I just want to assume for a second that I buy this bicycle right here and it puts me back $2,000. I'm just going to say that the cost of that bicycle was $2,000. And I'm going to depreciate that bicycle over the amount of time I plan to use it. Let's just say, for the sake of argument, I'm going to use that bicycle in my popsicle delivery business for 4 years. Now, you might have a preconceived notion about what depreciation is. If you've ever bought a new car or talked to someone that bought a new car, you may have heard someone say, the second you drive a new car off the lot, it depreciates in value 35%. And that's true. But that's not what we're doing from an accounting standpoint. I'm going to show you what accounting means in depreciation, and hopefully you can start looking at it that way instead of the way we looked at it before, where depreciation is a decline in value from using up property. Okay? So I got my popsicle bike here, paid $2,000, 4 years. I'm going to start my business. I'm going to show you why we depreciate property first of all. Let's just say if we didn't depreciate this property, I bought it in year one, so I'm just going to put $2,000 down for an expense here. Okay? And I don't want you to pretend that that's my only expense in the business. I grow the strawberries in my backyard. There's no expense in that. I repurpose popsicle sticks that my daughter has used, and I make my popsicles with those, so I don't really need to buy any popsicle sticks. The only expense I have is that bicycle. It's powered by my foot power. Don't need to pay for gas or anything like that. So just pretend the only expense I have is that bicycle. So let's just say, for the sake of argument, that I sell $600 of popsicles a year. So I'm just going to put $600 on here for revenue. Look what happens in year one. If I put that entire $2,000 down as an expense in year one, my net income is a negative $1,400. I lost money in year one. Assume I sell $600 going forward every year. And I don't have any expenses. Look what happens in year 2, 3, and 4 of my profit. Everything I sold in revenue becomes profit. So this is not the way we should do it. If we do it that way, we take a great big loss on the year we buy our equipment, and then we have really big profits in the years that follow. Okay? So this is not the way we want to do things. What we want to do is we want to take the cost of that asset, that bicycle, and we want to spread it out evenly over the years that we're going to use it. Instead of taking it all at one time, I'm going to spread it out. That's exactly what depreciation is. It's not tracking the decline in value. It's not measuring wear and tear. When we depreciate an asset, all we're doing is we're taking the cost of that asset and we're spreading it out over the years that we're going to use it. Okay, you got that? That's a really, really important point. Depreciation in accounting has nothing to do with the wear and tear on that asset. It has nothing to do with the decline in value. All we're trying to do is take the money we spent on that asset and spread it out over all the years that we're going to use it. Okay? So really, instead of doing it like that, what I would do from an accounting standpoint, I'd take that $2,000. I'm going to divide by 4 years because I'm going to use it over the course of 4 years. And that gives me $500 a year. So instead of taking all that asset's cost in year one, I'm going to take $500 a year and depreciate it. $500 a year. Still going to assume the same amount of revenue. So now instead of having a really big profit in years 2, 3, and 4 and a loss in year 1, I have a little bit of profit every year. That's a more accurate reflection of what's going on because I'm using that asset to generate revenue across 4 years. I should be recognizing some of the expense of that asset across 4 years right now. That's the idea behind depreciation. Okay, it's very important that you understand what we're doing from a theoretical standpoint. We're just trying to spread the cost of that over all the years that we're going to use it so we can match up revenue and expenses. The revenue we earned in that year and the expenses that were incurred to generate that revenue. So that's a real quick overview of what depreciation is. I'll show you the journal entries in another video and we'll kind of walk through some examples, but I just wanted to have an idea of the theory behind what we're doing when we depreciate an asset and kind of put some of the old ideas about what depreciation might be out of your head. If you have any questions on that, let me know. Be sure to check out some of the other examples that I do where we actually work through a few problems in journal entries.